Most people think flipping houses and building a rental portfolio are two different games. Pick one or the other. But the investors who actually build serious wealth, they figured out something different. They use flipping as the engine that funds their portfolio. They flip to generate the cash. Then they recycle that cash into rentals that pay them forever. One strategy feeds the other. And when you do it right, a single $100,000 flip can be the seed that grows into a $500,000 rental portfolio. And that's exactly what we're going to break down today. Stay with me, because by the end of this video, you're going to see the exact handoff moment where flip profit becomes rental equity, the math that makes it work, and the mistakes that cause most people to flip for years without ever building anything permanent. Let's get into it. Here's the pattern that plays out constantly in real estate. Someone learns to flip houses, makes $30,000, $40,000, maybe $60,000 on their first deal. It feels incredible. Then goes back and does it again and again. 5 years later, they've done 20 flips, made real money on paper. But they have no portfolio, no passive income, and no assets generating cash while they sleep. But they have a job. A high-paying, unpredictable, exhausting job that stops paying the moment they stop working. There's even a name for it in real estate circles, the hamster wheel flip. You run hard, you make money, but you never actually get anywhere. Here's why it happens. Flipping income is active income. The IRS treats it like self-employment. You pay taxes on it like a paycheck. Sometimes 30 to 40% of your profit disappears before you can deploy it. And most flippers take what's left and either spend it or park it in a savings account waiting for the next deal. They never make the jump to buy and hold, but not because they don't want to, but because nobody showed them the bridge. That bridge is what this video is about. Here's the mindset shift that changes everything. Stop thinking of a flip as the destination. Start thinking of it as a vehicle. The flip generates cash. The rental portfolio is where that cash goes to work permanently. One flip done right can fund the down payment on 1 or 2 rental properties. Those rentals generate monthly cash flow. That cash flow builds reserves. Those reserves fund the next flip. That flip funds more rentals. It's a cycle, not a hamster wheel, more like a flywheel. The difference between the two is direction. A hamster wheel brings you back to the same spot. A flywheel builds momentum with every rotation. Here's the core principle. Every flip you do should either fund a rental, pay down debt on a rental, or build the reserves that protect your rentals. If your flip profit isn't doing one of those 3 things, you're running the hamster wheel. Now, let's talk about how the math actually works. Let's walk through a real scenario. You find a distressed property listed at $140,000. It needs $40,000 in renovations, cosmetic work mostly. New kitchen, updated bathrooms, fresh paint, maybe some landscaping. The after repair value is $240,000. You use a hard money loan to fund the purchase and renovation. Interest and fees cost you around $12,000 over the 6-month project timeline. After the renovations, you sell for $235,000 after agent commissions and closing costs. Here's your rough profit breakdown. The purchase price is $140,000. The renovation costs $40,000. Add the hard money costs of $12,000. The selling costs $14,000, so the total in is $206,000. The final sale price is $235,000, and your gross profit is $29,000. That's a real number from a real scenario. Now here's where most people stop. They take the $29,000, pay taxes, maybe keep $20,000, put it in the bank, and wait for the next deal. But here's what happens if you treat that $20,000 as the seed for your rental portfolio instead. $20,000 is not enough for a traditional investment property down payment in most markets, but it can be enough if you're strategic about the type of rental you target. Here's the play. You use that $20,000 as a down payment on a $100,000 single-family rental in a secondary or tertiary market. Midwest cities, smaller southern metros, Rust Belt markets with strong rental demand and low price-to-rent ratios. These markets exist, prices are lower, and rental yields are higher. And 20% down on a $100,000 property is exactly $20,000. You finance the remaining $80,000 with a conventional 30-year loan at current rates. Your mortgage payment should be around $530 a month. Now, market rent for that property for $900 to $1,000 a month. Your gross monthly cash flow before expenses should be roughly $470. After factoring in taxes, insurance, maintenance reserves, and vacancy, you're netting somewhere between $200 and $250 a month. That's not life-changing on its own. But here's what it actually is: a self-funding asset. The tenant is paying down your mortgage every single month. You're building equity you didn't have before, and you're generating enough cash flow to cover expenses and build reserves. Now do that 4 times. 4 rentals, 4 tenants paying down 4 mortgages, $400,000 in property value, and a combined monthly net cash flow of $800 to $1,000. That's your $500,000 rental portfolio. And it started with 1 flip. But those properties aren't standing still. In markets with even modest appreciation of 3 to 4% annually, that portfolio crosses $500,000 in value within 3 to 4 years of your first acquisition. Meanwhile, your tenants have been paying down your mortgages the entire time, and your equity is growing from 2 directions simultaneously. That's the flywheel. Here's something most people don't think about until it's too late. Flip income is taxed as ordinary income. If you flip inside an LLC, you're potentially paying self-employment tax on top of income tax. In higher tax brackets, you can lose 35 to 40 cents of every dollar you make flipping. But rental income is treated differently. Rental income is passive income. And the IRS gives rental property owners tools that flipping income doesn't get. Depreciation is the big one. The IRS lets you depreciate the value of a residential rental property over 27.5 years. That means every year, you can deduct a portion of the property's value from your taxable rental income, even if the property is actually going up in value. On a $100,000 property, that's a depreciation deduction of roughly $3,600 per year. Across 4 properties, you're sheltering over $14,000 in rental income annually from taxes. And there's more. Mortgage interest on rental properties is deductible. Repairs and maintenance are deductible. Also, property management fees, insurance, travel to inspect the property, all deductible. The rental portfolio doesn't just generate income, it generates tax-advantaged income, which means every dollar your portfolio earns stretches further than every dollar your flips earn. This is the layer most first-time investors miss completely, and it's one of the biggest reasons the flip-to-rental formula builds wealth faster than flipping alone. Let's talk about what goes wrong, because plenty of people try this and stall out. Mistake 1 is buying rentals in the wrong markets. The flip-to-rental strategy only works if the rental numbers actually work. Buying in a high-cost market where $100,000 in equity only buys you a $200,000 property with thin cash flow destroys the math. You need markets where your down payment buys a property that cash flows from day 1. Mistake 2 is flipping and spending, instead of flipping and reinvesting. This sounds obvious, but it's not. Flip profit feels like a paycheck, especially when you've been grinding for 6 months. The temptation to upgrade your lifestyle instead of funding the next rental is real. The investors who build portfolios treat flip profit like investment capital, not income. Mistake 3 is over-leveraging the rental side too fast. Buying 4 rentals in 12 months sounds exciting, but if you've stretched your reserves too thin and one property has a major repair or sits vacant for 3 months, the whole structure gets fragile. That's why it's important to build reserves alongside the portfolio. 1 month of expenses per property minimum. 3 months is better. Mistake 4 is skipping the market research on rentals. Finding a cheap property isn't the same as finding a good rental. Vacancy rates, local employment, population trends, and landlord-tenant laws. These factors determine whether your rental performs or becomes a money pit. Do the research before you buy, not after. Mistake 5 is treating every flip profit the same. A $20,000 profit and a $60,000 profit require different decisions. The bigger the profit, the more you can accelerate the portfolio. It's best to have a plan for different profit scenarios before the deal closes, so you're not making reactive decisions with real money. Let's paint the full picture. In year 1, you complete your first flip, $20,000 in usable profit. You acquire a rental, $100,000 single family in a strong secondary market. Its cash flow is $200 a month. Year 2, flip 2, rental 2 acquired. Total portfolio value $200,000. Monthly cash flow $400. Year 3, flip 3. You also do a cash out refinance on rental 1, which has appreciated 8% and paid down some mortgage principal. You pull out $12,000 in equity and use it to accelerate rental 4. Year 4, rental 4 acquired. Your total portfolio is $400,000 in property value. Monthly cash flow, $800, and mortgage balances are declining every month. By year 5, your portfolio value has appreciated to roughly $460,000 to $500,000. Your tenants have paid down a combined $30,000 to $40,000 in mortgage principal, and your total equity across the portfolio is somewhere between $150,000 and $200,000. And you built it with $100,000 in flip profit spread over 4 years. Let's be honest about who can execute this well. This strategy works best if you're already flipping or seriously considering it. You have the patience to hold rentals long-term without touching the equity. You're willing to invest in markets that have cash flow even if they're not your backyard. And you can separate flip income from personal spending with real discipline. It's harder if you're in a high-cost market with no access to affordable rental markets, you're flipping inconsistently with long gaps between deals, or your personal financial situation makes it difficult to qualify for multiple investment property loans. None of those are permanent blockers, but they're real pain points worth knowing before you build the plan. Here's the single idea I want you to walk away with. Flipping without buying rentals is trading time for money. Rentals without flipping is slow without fuel. But flipping to fund rentals is how you build something permanent. So I'll leave you with one question to sit with after this video. What would your financial life look like in year 5 if every dollar of flip profit you earned from here went directly into a rental instead of a savings account? That's it for now, and see you in the next one.